back at 4:12 on this Monday. Well, the G-20 wrapped up its meeting this weekend in Canada with member countries agreeing to cut their deficits in half by 2013. But until then, they will continue spending on their stimulus packages. For a look at the winners, losers, and what was really accomplished, if anything, we're joined by Don Galante. He's Senior Vice President of Fixed Income over at MF Global. Don says the euro remains a major concern as countries go further into debt. And also with us, Marcus Mabry, the New York Times Associate National Editor, former international business editor for the Times. He's been covering international markets for numerous publications, including Newsweek, for over 2 decades. So, gentlemen, great to have you here with Matt and myself. Don, let me ask you, first of all, G20, did we get anything really significant out of the meeting?
I think you got what you expected. I mean, the statement
is... What is that, not much?
Well, they have to lend credibility to the marketplace. They have to allow the debt to continue and people to get some confidence. So they have to show some leadership, and I think that's basically what you got. The concept that they're going to cut the deficits is a real statement, and now the question is, do they do it?
Yeah,
and that's what we have to wait and see.
The first thing I was thinking is, wow, it's that easy?
Yeah,
we can put a plan into place to cut deficits by 50% in a couple of years? I mean, how likely is that to even...
Some of that is actually natural, though. You know, some of these programs actually roll off by themselves. So some of that is for real, but I think the reality is it's going to be tough.
Marcus, I mean, you've been covering international markets for a long time. I mean, how much was rhetoric in your view, or how much did you really say, this is a real problem, we got to do something about it?
Well, it's definitely a real problem. Something had to be done. But some governments already started to do stuff, as Don was saying. Some of this stuff actually is stimulus spending that automatically is starting to roll off the books anyway now. The question, though, was, what's the bigger fear here? Is the biggest fear of a double dip in their global recession, meaning you have to keep government spending up to avoid that double dip? Or is the biggest fear here from deficits and long-term default and the dangers that presents, as we've seen in Greece and as we've seen in other European kind of sovereign debt bombs that are out there in the landscape? What I think rhetoric does matter in this case, because what won in the end was the fear of deficits as opposed to the fear of a double dip recession. The Americans really were on the other side of this. What I find really stark is the fact that the administration went into this, the Obama administration, saying that what matters is we have to keep spending so that we don't have a double dip in a recession, and they lost. There's a compromise solution, but in the end, I still think this administration lost. That was really surprising.
Let me ask you could they have won? How much does a $1 billion meeting like this, and apparently security was $920 million. How much does a $1 billion meeting like this really play out there, or how much do world leaders already know exactly what they're going to do and say? I mean, does President Obama coming over to your table and saying, dude, listen, you really got to do this, does that really work?
Sometimes retail diplomacy like that does matter. That leaders do matter. In this case, it hasn't mattered because the feeling is just too great. And really, you could actually call this, I think, Hitler's revenge. Germany, Europe's largest economy, most important economy, is scared to death of hyperinflation. They're scared to death of what the price of debt and over-indebtedness yield. Right. That's a historical fear in Germany. It is as real as their Nazi history, and they fear that that's what happened. That's what led to hyperinflation. It was the lack of fiscal conservatism. Now they believe that they must avoid that at all costs. It's ironic because I do think the real fear here in the short term is of the double dip recession.
Don, you agree?
Well, I mean, a double dip, I hear you, and when we talk about double dip, that's sort of a broad statement. I think the reality here is, which I think is unique, is these guys own this now. They made this statement, which means if they don't do it by 2013, there's an issue, and that's going to get played out big. That's right. The other side of that, though, is if they start to do it aggressively or too aggressively, you could have a real slip in the economy, much like that happened in the late 80s leading into 1987. I don't think it's a crash or a crisis type thing. Right. I just think that we don't move out of here, and we continue with slow growth, low inflation, which makes it more difficult. And that trend, that mega trend we see now to more conservatism, and that's why I think the Treasury market is doing better. Not a flight to quality, a flight to own something that's a high liquid item. Liquidity is a big issue today, and because of the last 3 years, and I think it will be the story going forward in the next 3.
Slow growth, though, will make it obviously much more difficult for these guys to cut their deficits, right? I mean, Obama's argument, which is one we've heard also from a lot of smart guys coming on this show, is you spend now, you boost growth, and then you'll be surprised to see how well growth does at decimating deficits.
Well, the problem is that if you look at recessions that are driven by real estate, the world's a little different place, and it takes longer. As you talked about double dips, those are real estate recessions. it takes a long time for real estate to move from weak hands to strong hands because of the credit equation in between. It takes a long time to build your credit back up. That's not something that comes easy. It takes time.
But with weak job creation, there's a fear that if people aren't getting jobs, then nothing else is going to be bolstered, and you'll keep having a downturn that might keep spiraling downward.
And in terms of job creation, I mean, folks are saying that, it's going to be a long time before we see the levels that we saw in the heyday, whether it's, 600, 700,000, jobs created a month. It's going to be a long time before we see that.
Oh, I think that's right.
People are sitting on cash, as you said.
Right.
But the issue is you say, okay, well, in my real business, not the financial business, not, using money to make money, but the business of creating product, you don't want to spend that money unless you're very comfortable you're going to get a return on it. Rightfully so. So it's going to be interesting.
And without that faith, you're not going to see jobs being created.
That's right.
And how do you think it's going to affect the Treasury market? Since we have you here, let me ask you what you think about Friday's number. What do you think it's going to be, and will a disappointment sort of stimulate a real flight to quality?
Well, I think the consensus is down 115 related to the census workers and those rollovers, which distorted a little bit. And the second wave is the number, which I think people are talking 97, 98. It's kind of interesting in my career for the years that I've been in the business. Usually around the 4th of July, you do get a change. Don't forget you had quarter end. So there's a lot going on in balance sheet dressing, especially with FinReg coming right now with companies. So as we get through there, I think you're getting a truer picture starting in July. Unfortunately, it's the summertime, and we are in a low volatility window. I actually think you're going to go sideways for an extended period of time here until FinReg gets actually the start of institution of FinReg, and some of these other components start to play into the market.
Mark, you kind of agree with that in terms of what you're hearing about the outlook here for the job market? And
yeah, absolutely. I mean, I think the best case scenario at this point is weak growth. But the fact is, we could be seeing, again, because of this lack of faith in the future and this fear, and everyone wanting to stand on the sidelines and not spend any money and harbor their liquidity.
What's the biggest fear right now? And the only reason I bring that up is, we just got through reg reform. We've got to see, get the vote there. But I mean, it seems like the wall of worry, we've kind of crossed off some of the things that we were worried about. Of course, there's the implementation of reg reform. But I mean, what is the biggest concern here?
Well, I think it's still all the underlying realities of it. It's the weak job creation, the fact that companies aren't spending to invest in the investments that would create jobs. And I think, that lack of faith is the deepest fear. And that's why the Obama administration want to keep spending money. But that, again, from the European point of view and from the Canadian point of view, obviously from the G20, the fear is one of too much debt out there, and we have to get our kind of debt appetites in order.
Except for financials, John. We should point out financials have started hiring again. They're bringing people back and fighting for them. They're guaranteeing bonuses again. Things are getting back to...
All is well on Wall Street.
Well, I'm not. I mean, there is some of that going on. But, to your point about the fear, I think it's the fear of the unknown, right? And one thing that's going on right now that I see is that the market's doing better on high-quality stocks, companies that have a lot of cash or have high names, have good product movement. But the low-quality, the banks are not lending to low-quality companies.
Still.
It's not like money's flowing to companies that are not a good credit.
Still the problem.
It's not. And that's healthy in one way, problematic in another. And the other side of that is, where's the Fed going to go? What's the Fed going to do if things start to roll back over?
We got to run. Don and Marcus, thank you.